Uncertainty is always a factor in markets, but as we face this trading week, levels of uncertainty and fear amongst investors have risen. And last week we saw in the end what appears to be a rational addition of a risk premium to owning shares. That is, shares were sold down to reflect the increase in risk that the escalation in the Middle East represents. Now, we got there in the end, but the US markets were atypical. Here in the Asia Pacific region, we saw a lot of selling pressure over the course of the week. The ASX 200 finished down almost 4%. The Hang Seng rallied hard on Friday, and it was still down more than 3% for the week. And as I say, these look to me like rational responses to a lift in geopolitical risk. But in the US, we saw a lot of flip-flopping, and facts remained largely the same throughout the week, but the interpretation of them by investors kept changing. And so we saw big gains and big losses on subsequent days in the US. And after falling more than 1% on Friday, the S&P 500 only finished the week down around 2%. And that might mean that we're going to see further pressure. We've certainly seen that at the open this morning. Petrol prices, gas prices, crude oil prices have surged. The crude oil futures contract is up 19% in early trading today. The Australian market has opened very poorly. It's down more than 3% in trading in the first hour. And it looks like the pressure that we're seeing on share markets is likely to be reflected throughout the region today. Of course, it's also having a huge impact on individual stocks as investors work through the implications of this increase in heat in the Middle East. Norwegian Cruise Lines was down 19% last week after concerns arose about not only the direct cost of fuel, but the impact that this inflationary impulse coming out of the Middle East might have on consumers. On the other hand, Palantir was up 15%. Its technology and its military applications really attracting the attention of investors. BHP was down 8%. And the key global supplier of industrial commodities was repriced after an initial boost as investors expressed their concerns about the growth outlook. On the other hand, Karoon, which is a gas supplier, was up 20% on expectations that the fossil fuel complex will continue to move higher. So it's really having a significant impact in individual stocks. But it's very clear that overall fear is rising. The VIX traded at 29.5 on Friday, well up from those lows below 20 that we saw just a few weeks ago. And it's very clear that that continued rise in the VIX is reflecting rising fear in markets. Oil traded over $90 a barrel, and there's a lot of calls for higher oil prices still. Gold, in a clear sign of risk aversion, rose again and got close to $5,200 US. And the US dollar itself also rose, another clear sign of risk aversion in markets, and it breached the 158 Japanese yen mark. On the economic front, the news was also poor. In the US, we saw non-farm payrolls actually drop by 92% in the previous month, 92,000 jobs in the previous month. And that was against expectations of a gain of 50,000 jobs. The unemployment rate surprisingly jumped to 4.4%. Now, this is very poor news coming at a time of bad news on an international front that the US economy also seems to be sputtering. We've got CPI data on Wednesday night that could be crucial to the outlook. Naturally, a number of people are rushing to the idea that we'll see rate cuts on the back of that weak employment data, but with inflation on the rise and the inflationary impulse in oil markets in particular on everyone's radar, I think that would be a difficult call for the Fed. So CPI on Wednesday night will speak directly to that question, and if it's a surprise, we could see another severe market reaction. So that big rise in the VIX is the highest that we've seen for the VIX since the tariff-induced sell-off last April, what was referred to as Liberation Day, somewhat ironically. The tariffs introduction really scared markets, and the immediate slide in share prices was reflected in that increase in fear. With the VIX heading up to those levels again, we have concerns that we could see a further market reaction. The reality is that the Straits of Hormuz are unpassable at the moment, so no oil is coming out of the Persian Gulf, and that impact will continue to echo until the situation is resolved. A number of Middle Eastern producers, including Kuwait and the UAE, have cut their production already in anticipation that they won't be able to move anything that they pull out of the ground. And so Iran has explicitly said that it's seeking to strike refineries in the region. And that, of course, means it could be longer lasting infrastructure damage, even if we do get an outbreak of peace. So US gasoline has already moved up 27 cents a gallon. Jet fuel is up, of course, and a number of analysts already leaning towards the idea that the increase in jet fuel will lead to a 10 to 20% airfare hike. The elevated oil price puts massive pressure on all economies, according to one local analyst. Goldman Sachs have called for oil to break through $100 this week, and suggesting that unless there's a resolution of the situation, we could see a breach of that previous peak from 2022 in oil prices at $130 a barrel. So one to watch out for. There clearly some concerns about rising prices. Another local analyst has said that there is a big opportunity in some stocks. In other words, the discount that's being factored in, but the caveat there is it would require an end of the dispute in the Middle East in the next few weeks. So once again, future is uncertain. Turning to individual stocks on our watch list today, top of the line is Carnival, down almost as much as Norwegian Cruise Lines in the last little while, down 18% last week, with higher fuel costs one of the major factors there. However, both Norwegian Cruise Lines and Carnival have been in a strong uptrend previous to this disruption. And in fact, Carnival reported at its full year net income was up 60% last year. And that's one of the key reasons why the share price previously had such positive momentum. So if this situation is resolved quickly and oil prices quickly settle down, Carnival could well be in bargain territory, but that's a very big if. Number of analysts have got a strong buy on Carnival. Targets are around $37, currently trading around $26. So significant upside suggested by those analyst targets. One to have on the radar at least. A stock that is benefiting in this situation is IBM. It was up 8% last week. It's regained a lot of the territory from the massive slide that we saw last month when there were concerns that AI would cut IBM's lunch on the basis of an AI agent that could cut the code required to transform IBM's hardware contracts. So that big slide in the share price has now been fully recovered. IBM announced a US $112 million defense contract with a strong AI enterprise offering within it. So the mainframe fears have been overdone, according to some analysts. Number of buy ratings on IBM, and with targets well above $300 a share, in other words, more than 30% higher than current share price, there are some reasons to also have IBM on the radar. And the last stock on our watch list today is Northern Star. It fell 10% last week, and all gold stocks were down, and the Australian gold subsector was down just a bit over 8% anyway, but Northern Star was one of the most affected. The gold price did fall last week, and that's where a lot of the pressure on gold stocks came from. And it was interesting to see on Friday night, the US dollar strength was not an impediment to a rise in gold price, and that does point to some pretty strong demand. Northern Star was up 56% in 12 months. A number of analysts still have a buy rating despite that very sharp rise in its share price. In fact, one of the local brokers this morning reiterated its buy rating on Northern Star.